Welcome everybody to the Planet MicroCap Showcase Virtual. I'm your host, Robert Kraft. And for our next keynote presentation, this has been 2-3 years in the making. This might have actually been 10 years in the making because you'll find out in a minute. My guest today, and this is as part of our series on Planet MicroCap Podcast called the MicroCap Graduation Series. This is actually someone that's done that 2 times. And he's still a young guy. I mean, look at this guy. He's still a young guy. So joining me right now is Hamed Shahbazi. He's the chairman and CEO of WELL Technologies, publicly traded company. The symbol is WELL on the TSX. Hamed, this is an absolute pleasure. Thank you for joining me today.
It's a pleasure to be here. Thanks for having me.
It's great to have you. So, the way I structured this interview is I wanted to kind of do it in 2 parts. The kind of the background, the founding and selling of TIO to PayPal, the transition to WELL Health, and then getting into some more of the general, all right, what have you learned kind of questions. So to start off, what is your background? Did you know you always wanted to be an entrepreneur?
Yeah, it's interesting. When I think back to my sort of school days in University of British Columbia, I was really tormented by not exactly knowing what I wanted to do. But having a really fierce pull into business. I mean, my parents all had different ideas. My mom wanted me to be a doctor. My dad wanted me to be an engineer because he was an engineer. He was a PhD from Berkeley, and he had an engineering consulting firm. And truthfully, sort of neither of those really tugged at me very hard. But I did end up going to engineering school because I saw it as the shortest path to business. At the end of the day, I wanted to do something creative, and I didn't really want to be too pigeonholed to any one sector. And that was, I think, in some ways, interesting foreshadowing for the rest of my career, because I did feel that was good, and it was a good education to go to engineering because it's just 4 or 5 years of solid problem solving, right? And the process of problem solving, and just gives you the confidence to problem solve. And I think immediately after that, we started to see kind of the rise of the internet, really. I mean, in late 90s, and that was enormously interesting for me, and kind of really pulled me into founding at that time. The predecessor name to TIO Networks was InfoTouch Technologies. So that's kind of the road that I went.
I mean, look, that's a perfect segue into getting into that part of your story, and I just wanted to make note, as I said, I've been really looking forward to chatting with you. It's been a couple years in the making because in the relatively short time frame, in 4 years, you had your TIO exit and then launching WELL Technologies. And for me, actually seeing you do your presentation on TIO was one of the first investor presentations that I ever saw in this space. I think that was at an LD Micro back in 2011. So it's been long, like I said, it's been a long time coming. So, as you alluded to, first things first here, for those who don't know the TIO story, what really led to your founding of TIO in 1997, and what was the original problem you were looking to solve?
Yeah, so because of that kind of the rise of the graphical internet and all the enthusiasm that was coming in, what started to happen at that time, of course, there were no smartphones. And so access to the internet in public locations was something that didn't really exist except for public access internet kiosks. And so really, when I founded the company, the thesis was to enable that access and help sort of bridge the digital divide. There were some, lucky people that had it at home at that time, and there's some people that didn't even have it at home, right? And so the ability to enable people to access the internet, and there were some sort of verticalized sort of B2B solutions that we did for banks and different sectors, and then there were sort of these generic public access vehicles that we developed. As you probably, if you're old enough, you'd remember the cyber cafe days. There'd be like retail locations where you'd walk in, computers lined up everywhere. And so I remember one of our earliest products was cyber cafe management software, where we had a self-service kiosk that would enable you to actually, come up, put a bunch of cash in, and then it would power your cyber cafe terminal. You would then go there and sit down, and Chapters Books and a bunch of others folks were using these systems of ours. But what happened is we sort of developed a lot of management capabilities for self-service devices. And what we did is, as the internet became more commoditized, we started to evolve those deeper and deeper into B2B solutions. And then we developed bill payment kiosks that were incredibly useful for low to moderate income people who are cash preferred, mainly in the United States. There's still, believe it or not, a cash preferred segment of the population there. It's obviously shrinking a bit now, but it's still quite stubborn. It's still quite large. There's still billions of dollars worth of cash that are transacted, and so those kiosks came in handy, and they processed many billions of dollars worth of cash payments for your light bill or your cell phone bill, cell phone recharge, all kinds of different transactions. And TIO was really probably the market leader in that sort of self-service kiosk solution for those types of last-minute payments in the United States at one point in time.
Very cool. I mean, so what were some of the growing pains, in the process of starting that out? And I don't know if this ties in at all or not, but I mean, is that some of the reasons why you ended up taking the company public earlier in its life cycle?
Yeah, I mean, I took the company public early was because at the time in the late 90s when I started the business, there wasn't really a formidable VC presence here in Western Canada, and there was some high net worth people once in a while that would give you money.
Is there still? I don't know.
Yeah, I think it was not as well formed. And I was a young guy. I mean, I was 22. So if there was, I didn't know where it was. But what was clear was that there was this kind of public venture capital, and you still hear about it today. And we're fortunate to have the venture exchange, because it does allow microcap companies to list and get going without a lot of minimum requirements. So I think that's really helped innovation here in Canada, and I think continues to be a really important part of the ecosystem. So that's how I funded the company to begin with, and we actually had our IPO, I think, in 1999, believe it or not. And the IPO was a full wholesome $1 million at that time.
Aw, like you can hear everybody be like, so. But I mean, you're 22 years old now, public company CEO, and we're talking about the venture even in 1999. In those days, I mean, it's still before my time, but from the stories I heard, it was like the wild, wild west. So I mean, not only being 22 years old, being public company CEO, but being public company CEO in the TSX venture. I mean, what was that like?
Yeah, I mean, it's exactly what you're mentioning. It's obviously the mining guys were high flying, and it was kind of exhilarating and somewhat frustrating to watch how these incredible capital flows would come into these companies and lift their stocks, and they would, and you were like, they have nothing, what do they have, so, but I mean, of course, so much has tightened up around that industry, and obviously it's changed a lot, and I think rightfully so, in terms of protecting shareholders. You asked about some of the challenges in the early days. I think it was just here we are, a small Canadian microcap story, trying to become important and knowledgeable about the U.S. financial system and become players in the U.S. And I think that just took time. That took a lot of relationship building. Part of it for me was just getting out there, and frankly, I just started going to a lot of those U.S. conferences and shows and symposiums, and press a lot of palms, talk to a lot of people, build relationships, and eventually, I started to build relationships that really, you get that first partnership, you get the second partnership, you kind of build brick by brick by brick, right? And so there was no shortcut. It was definitely something that required a lot of painstaking hard work, and of course there was no Zoom back there, so everything you did on a plane, and it was painstaking. Everything took a long time, and And of course, any kind of connecting the dots with large financial systems and banks and getting to be known by them, it just, everything took a lot of time. So yeah, those were the types of challenges, but we broke through. And eventually, obviously, the company became a multi-channel bill payment processor. It wasn't just the kiosk is sort of how we got our way in there to demonstrate value. But eventually, we were on mobile, online, kiosk, point of sale. We had open architecture with third-party APIs, and it just became anything that was sort of off-bank processing we did, and processing many billions of dollars a year.
So what would you say was that big turning point then for TIO Networks that saw growth from that microcap to small cap, and I guess another question to throw on there is, clearly, when did the conversation start with PayPal? For those who don't know, on February 14, 2017, by the way, a great Valentine's Day gift. PayPal announced that it would acquire TIO Networks for approximately 302 million Canadian, 238 million US. So, what was that tipping point where these conversations started becoming more and more real?
Yeah, I mean, really what happened was, as the company grew its base of billing partners, it became more and more important to the ecosystem. And, the company had a great culture of growth. I think we had something like 36 consecutive quarters of transaction revenue growth, which is all kind of, highly reoccurring revenue, not exactly recurring revenue. Some of it was recurring, but it was like transactional revenue that was highly predictable. So it was very attractive. In today's terms, it would have been, probably a lot more valuable than what it was sold for. It started to garner a lot of attention when we started to do more M&A, which made a lot of sense for the Canadian. If you consider the Canadian investor, as a catalyst junkie, they love, sort of these events that demonstrate significant accretion and dilution. Like accretion when you consider the dilution in one shot. And we, became pretty good at being able to demonstrate that, hey, we just raised some money to buy this. It's trading, or valued in this way. Here we're valued in another way, and you can tell that it's incredibly accretive to share capital. It's very good for shareholders, and I think learning how to do that, I was fortunate to get a mentor who's a fantastic capital allocator, and I just fell in love with the idea of allocating capital to grow value in these sort of quantum events. And that helped a lot. I mean, within 3 years of starting our M&A program, we probably added $250 million worth of value to the company's currency. So
that's great. I mean, who was your mentor, by the way?
Oh, Steve Sadler he's the chairman and CEO of Enghouse. He used to be, I think he's still on the board of OpenText, and responsible for M&A committee there. He was the chairman and CEO of GIAC. Took that to over $1 billion. Really a clever guy. I think probably one of the best software M&A people on the planet. It's just incredibly bright guy, and I was very fortunate to have him spend some time with me. And because of that, I try to be helpful to other entrepreneurs, because it's always great when someone takes the time, and they don't need to. They don't get anything for it other than knowing that they've been helpful to someone, frankly.
Right, and paying it forward. Yeah, no, totally. So then, all right. Well, by the way, we can totally see where the groundwork for what you ended up doing with WELL Health came in, right then and there. But we'll get to that in just a second, because I want to put the bow on TIO and that acquisition. So, what was that day like? Gotta ask. You made the announcement. It happened.
Yeah, it's bittersweet.
Big deal.
It's the company was sort of about that stage of about 100 million in revenue and quite profitable. I think you're 15% plus EBITDA margins and growing, and we felt really confident, and but they're a great brand, and our board, of course we have a board of directors and a special committee, and there's all kinds of governance that goes into stuff like that. But yeah, I think it was nice validation for what the team had created, and you know, again, a bit bittersweet because it was such a long journey, but definitely you know, something great to share with your team.
Oh, I'm sure. I'm sure that must have been a pretty. Yeah, I can understand how it could be bittersweet though. At the same time, it's like since 1997 and probably even a little earlier than that because you thought of the idea. I mean, that's was that 15 plus years of your life. You grew. You went from a young man to a man. I mean, starting family. I'm sure during that time, like it's a big deal.
Yeah, no, it really is. You know, it's an entrepreneur's journey, right? I mean, it's never a straight line, and TIO is not a straight line, and there were many frustrating points, and you know what I'm really proud of with TIO is that we didn't give up. We continued to uh, work hard every day, and we built it's a very unlikely story to build a
Yeah.
U.S. fintech powerhouse from Vancouver, uh, you know, not having the ability to kind of draw on, you know, subjects in your own country to grow revenue and business, always having to, I mean, I think I've been to 42 of the 50 US states. I've traced, you know, like I've been everywhere. I've talked to everyone, and that was just I think a bit of a character building exercise too. It was just you know, this unbridled determination to do whatever it takes to drive this business forward in the face of, you know, whether it would be market concerns or you know, any kinds of friction that you would encounter. And so you know, I learned a lot, and I think one of the reasons why I really wanted to start Well is because for many years, you know, I learned how to be a capital market CEO, and when I look back now, I can see all the mistakes that I made. I can see, you know, how I could have made TIO work quicker and faster, better had I know all the things I know today. And I was like, well, I'm still healthy. I'm still relatively young. Why don't we do this again? And for me, I consider myself as a tech generalist, you know, and so I've been involved with obviously, you know, TIO, and I helped start and was early in broadband TV, which is another tech enablement of a media theme, and I'm still on the board. I'm the lead director there, and then Wells tech enablement of wellness. So you know, you have financial, you have media, you have wellness, and obviously, you know, healthcare. But for me, healthcare, really what TIO means uncle in Spanish, and a big part of TIO, it was a purpose-driven company. That's really what drew me and kept me at TIO for as long as it did, was we were saving low to moderate income people hundreds of millions of dollars by the time we were done every year. You know, these were people who, if they needed to wait to the last minute to pay their bill, they would go to like a Walmart or some retail location, and they would be charged 10 or 15 bucks just to pay their light bill and escape, you know, a disconnection fee. And so we built last minute, you know, real time or close to real time connections with these light companies, and we would charge $1 or $2 or nothing because we get paid by the light company. And that was a game changer. That saved enormous amounts of money for a very challenging group of people where combined household income was less than $60,000. And so I was really proud of that, and I really liked the purpose aspect of the company. But I was always itching to do more for them, and it was hard. I had visions of TIO lending them money and, you know, doing a lot more. And so that you know, to me, there is no bigger sector from an impact perspective than healthcare. I mean, everything you do by definition is designed to help people, you know, grow their longevity, you know, help them be more, you know, healthy or, you know, live long, you know, obviously longevity, live longer, or just you know, be more comfortable. I mean, you think about when you have a health concern, you're at your most vulnerable. You are scared. And it's remarkable what healthcare, you know, frontline healthcare people do. They're there at a time that's most vulnerable for you. And tech enabling those people, helping them be more efficient, helping them be, you know, more capable, improving their chances of success is an incredibly gratifying thing to do. And so to me, that's what drew me into that area. And that's why I ultimately decided to start the company, drive the business, and you know, be this CEO and go after it really with a with a lot of vim and vigor.
Right. Yeah. No. You hit on my next question because look, as you said, with TIO getting acquired, how and why did you transition to your current role at Well Health Technologies in May 2018? I mean, why you clearly had in your head, I want to do something in healthcare because I want to not just give back, but find something that can truly have a positive impact on a lot of people. So
Yeah.
why was Well the right deal for you as your next move?
Yeah, I mean, it's interesting because I had started a company that was actually, that actually preceded TIO, even being sold. That was involved in the wellness space, and because I was at TIO, I had hired a CEO, and that was focused on wellness beyond, like, outside of the healthcare sector, and it was focused in areas that would help you age gracefully, so technologies like yoga, meditation, if you can call them technologies, and and when we were sort of evaluating sort of and we had a partnership with Dr. Deepak Chopra, and there was some interesting things we were doing, but when we were really evaluating where this business was going, and how big it could be, what we realized is if we really want to make an impact, the real action is in healthcare, like not sort of this offshoot of it in terms of just general wellness business, but actually enabling practitioners. That's really what really excited us, and yeah, and that's when I did. There was some research that I did at the time that really pointed to the lack of digitization and modernization in the space that frankly surprised me, and then I started to integrate the knowledge with my own experience. I was like, oh yeah, like when I went to a clinic last, it was a terrible experience. It was not digital at all. How long will that last for? Probably not long. I mean, someone's going to come in and disrupt, and I'll say positively disrupt, because you never want to come into healthcare and turn it on its ear, right? There's lots going on. You want there to continue to be, whatever is working needs to work perfectly, but if you can come in and change and provide change management and help tech enable, which again, no sector evades digitization. And so knowing that would happen and it hadn't happened yet was an enormous realization for me. It was like, wow, this hasn't happened yet. Our experiences are going to change. And so what an opportunity to be involved in that. And this is what I love to do. I love to apply technology to sectors that haven't necessarily been fully modernized yet, and be part of that that sort of momentum and that progress, and hopefully benefit from it as well with a group of shareholders.
Absolutely. So then what is the thesis that you knew that if I hit these inflection points, Well will start to recognize fast growth and shareholder value? And by fast, I mean, since taking the job as CEO on May 23rd, 2018, where the stock closed at around 58 cents. And as of yesterday, we're recording this on April 14th, but as of close of yesterday, April 13th, 2021, the stock closed at, I think it was $7.60. So you're looking at approximately 1,210% increase. I think my math is correct. Either way, it's a lot. So, what was that thesis that you knew if I hit these inflection points, Well will start to recognize fast growth and shareholder value?
Well, I guess because of my experience at TIO, I started to understand what shareholders were looking for. And I think, I think what you see a lot of times in microcap and small cap companies is management teams raise a lot of money, and they really pursue what I call a sizzle strategy. And they're like, hey, I don't need revenues. I need to be in this business that everyone's talking about, and all I need to do is throw my hat in the ring, and I need to show traction, and I need to show progress in these areas. And the moment I start talking about revenue and EBITDA, people will think I'm, that's somehow, does not have a place in this industry. And my view is you need sizzle, but you also need steak. And so, and the entrepreneurs that have been able to demonstrate not only an opportunity to participate in the exciting aspects of an industry, but also show real revenue and margin progression, um, that's what really starts to get people excited. Because eventually, as you know, these industries come in and out of favor. And the only thing that really endures is, the numbers, right? I mean, and what do the numbers look like? What is the top line? What is the bottom line? What is, there's this sort of rule of 40 that bankers look at a lot of times, in terms of the growth rate and the bottom line profitability percentage equaling to 40 for technology companies. And so, yeah, I mean, I think what we did at Well was really be focused on making sure that while, yes, digital health is great and we need to be participating in areas that are experiencing that burgeoning growth and interest, what other, bona fide, KPIs could we really hang our hat on to demonstrate that these things were working, our revenue was progressing, and so that informed our M&A and corporate development plan, our operating plan. And so, and if you look at the business, I mean, the numbers, sure, we haven't been bottom line profitable in the first couple of years, but the losses weren't that great, right? They're pretty reasonable. And in 2020, just the year that just finished, we're pretty much break even on an adjusted EBITDA basis. So basically our third year of operations, and I'm really proud of that. And now, of course, Q4 was profitable, and we expect profitability moving forward. And so, to me, that's when you start attracting more of the institutional base of investors that are really buying into a management team's discipline. And that's ultimately what a lot of these people do. And obviously, they have a lot of criteria, but I always tell our team, you have to think of a stock as a product. Go to a supermarket and look at the thousands of products that sit on shelves. That can be analogous to what's going on in the stock market. There's just so much to pick from. So how do you differentiate? How do you leap off that shelf for shoppers or investors? And to me, a big part of that is the trust that you engender as a management team, and everything goes into that. Whether it's discussions like today's, it's every shred of disclosure, every decision that you make, comp decisions for yourself. I'm not taking a salary at Well just yet. Everything that I've done, I've been taking it into restricted stock. I put in, $6 million plus of my own capital. I've participated in every round that management has been allowed to participate in. So, when you show an alignment with your shareholders, and you show that, hey, I'm a shareholder too. I don't have a different way that I'm going to make money from you. We're all in this together, and we're making decisions that will enhance shareholder value. That's really when you start to, I mean, trust is something that's gained very slowly and lost very quickly. And so I was fortunate at TIO to also struggle for a long time and build a lot of trust with a lot of people that were like, man, this guy just won't go away. This guy just keeps trying and keep trying. And this is why I think Well hit the ground so quickly with analyst coverage. I mean, we had 10 analysts cover within the first couple of years. And a lot of that was, I know that guy. He's either going to make this successful or he's going to die trying. Right. And so I think that's a big part of the journey and why why we ended up where we did here with Well.
And if there's one thing that you can always live with, is like, if that's my reputation I have amongst the financial community, I'm good. I mean, that right there is everything.
Well, it is, because it's without that trust, it's hard to raise money. And yeah, if you don't have it, and you've got good ideas, and people will take a chance on you. But it's just a bit harder, and
gotta perform.
Yeah,
perform.
Exactly.
Bottom line, right? Like, you just put your money where your mouth is. Just go do it.
All about performance. Yeah.
Yep. All right. So now I'm getting into part two of our interview today, which is kind of now that we have the full background, your experience, and where you're at today with Well, I had a few public company CEO general questions. So, as a CEO of a publicly traded, both microcap and now small cap company with Well, with a fast growing business, how do you currently balance the responsibilities of business operator and CEO?
Um, Excellent question, because Well is positioned as a capital allocator in the tech-enabled healthcare space, and so we think about the question you just asked a lot, because it is the very essence of why we can buy as many companies as we can, as we do, and how we're able to fit them in, ensure that they operate properly post transaction. And a big part of that is our decentralized business unit structure. We kind of refer to ourselves, aspirationally speaking, as like the Berkshire Hathaway of tech-enabled healthcare. And breaking down that statement, Berkshire Hathaway is a holding company run by Mr. Buffett, designed to invest in great businesses, but not change their management. It's to give them a safe place where they can continue to execute on their business plan. These aren't broken companies; they're healthy companies that are coming into his sort of orbit, and I'm sure they somehow benefit from it. But for the most part, they're just kind of operating as is. And when they need capital, they go to they go to Mr. Buffett and his team, and that is really one of the only things that's centralized at Berkshire Hathaway, is the allocation of capital. Otherwise, so much is delegated to that CEO or that management team. And I think what that does, when you create a culture where you're bringing in leaders and you're empowering them, and you're not micromanaging them, is that that engenders a trust that, okay, I want to be here, I'm empowered, as opposed to, okay, I did this transaction and I joined this business and I can't wait to get out because I can't create anymore. I can't develop the business the way I want to anymore. And that's what leaders really want to do. So I think operationally speaking, we really believe in the idea of the ideals of empowering leaders to be leaders, and we try to centralize as few of things as we possibly can. Capital allocation is certainly one of those things, whether it's for corporate development or just investments in OpEx so that you can grow. And we have hurdle rates. We have a lot of sophistication around how we structure these types of things.
Absolutely. Well, you know what? I'm going to get to my next question here. I was going to ask you about a balance question, but we'll get back to that, because you're starting to talk about something that you really laid the groundwork at TIO, which was this idea of M&A and how you go about your capital allocation strategy, in particular for those corporate developments, right? Bringing in new companies into the fold. So with Well in particular, and really just in general also, what would you say is that capital allocation strategy, and how do you evaluate potential acquisitions to bring them in? I know the company recently announced the CRH acquisition, so I'm sure, there's a lot that went into that.
Well, conceptually, an acquisition has to be sort of accretive on three vectors. It has to be financially accretive. It has to be strategically accretive, which to us means that we have to obtain something that we didn't have before. Some advantage, some platform extension, some kind of benefit beyond the financial accretion. And then third, it has to be culturally accretive. We can't become less of a desirable culture because we did this acquisition. We have to be more we have to bring people into the company that we're really excited about bringing in. And so that's sort of what it is at the highest levels. Now, when you kind of get a little bit deeper, we have a number of different criteria, and now we have watch lists and target lists by business unit. So we have a business unit that's focused on patient services, what we call our clinical division, and this is the one where we first started. That one has very defined EBITDA ranges. It has a lot of different criteria that we've learned, and we're always integrating knowledge. So we're always taking learnings from our quarterly results or what's going on in the business, and then we integrate that into our criteria. That's what a really good culture, a learning, growing culture does, is it is always informing its way of doing business. And so it's getting pretty good in terms of knowing how to structure deals, how to keep leaders incentivized, how to do deals that we feel drive the currency of the company. And yeah, and that's and obviously, as you can imagine, we have a digital apps division that's very focused on platform technologies and a lot of SaaS revenue. And of course, you're not going to see exact alignment in terms of multiples between clinical patient services and platform technologies. And so that's why it has to sort of be that focused and refined, where you are looking at this differently. But I think that's what's really also unique about WELL, is that it's a healthcare technology healthcare company that is not just engaged in platform technologies that power other people's practitioners. It has hundreds of practitioners. We are a healthcare company delivering very significant number of patient visits. In fact, if you look at our business update from a few days ago, late in March, we're closing in on for that quarter. I think we did a quarter to date number where we had been close to about 500,000 patient visits that we had enabled either through our platform or through our own practitioners network. And that we just don't know anyone that's anywhere close to those types of numbers. And that was just for the quarter, which would infer millions for the year. And we could continue to add to that, and that would not even acknowledge our billing business or our EMR business or our cybersecurity business. So as you can imagine, WELL is becoming quite a force in terms of being able to again empower practitioners that are on our team and outside of our business, clear across the country, with telehealth, with physical in-person clinics, with all kinds of different practitioner tools and digital enablements.
Very good there. So, now my second balance question that I have to ask you, and you talked about this a little bit earlier when you were talking about the grind from 97 until sale in 2017 with TIO. And then also, you're still doing events, right? You're here right now. But how did you balance focusing on company performance versus telling both the TIO and WELL Health stories to the investing public? How did you balance that? Were there times where you're like, let's just keep performing, or at the same time, like, no, we need to keep balancing doing stuff like this and also just performing?
Yeah. Well, the balance comes from this notion that you just have to do both. But it's not elegant. I think what a lot of people are like, well, I'm going to create this perfect plan. And I love the quote from Mike Tyson, where it says, everyone's got a plan until you get punched in the face. And guess what? You wake up and you go to work and things happen that are akin to being punched in the face, and you're like, oh shoot, I didn't see that coming along. So what do I do now? The answer is you do whatever it takes. And so you do whatever it takes to run your company properly, and you do whatever it takes to ensure that your capital market strategy is going in the right direction. Now, obviously, that all entails bringing in other people and trusting them and empowering them and ensuring that your company is executing in a quality way. One person can't do everything or anything for that matter. And so I think it's obviously you strive for balance. There's ways that you think about what the ideal amount of time would be to spend on capital markets matters, and you can sort of look back and say, how much time have I spent? But I found that it wasn't elegant. I found that at times you would have to spend a lot of time and a lot of energy and worry about it a lot or act a lot, and then at times it would ebb and flow and you'd really be focused on the business, and there were sort of some incredibly important deals or situations that you needed to kind of get through and power through. So yeah, that's what I found.
I think that's a great way of looking at it. It's like it, you can talk about balance all you want, and
Yeah.
obviously you have your ideal of what that balance would be, but at the same time, like if you're on vacation and it's your first vacation in 3 years and you get that call, guess what? You're taking that damn call.
Most
It is
likely.
what it is.
Most
It is what
likely.
it is. So another pubco type question that I got for you, what with having two public companies, what was your thought process when putting together your board of directors? How did you think about that?
Yeah, I found that with the board, and I personally think a lot of people just choose for the splashiest name that they possibly can get, and they put it on their board. And I never had that view. I mean, I think that we have really great people on our that are on TIO's board, and obviously you need people that are accomplished and who are notable. But I think what's more important than just finding the person that you have come into contact with that has the splashiest name is that you actually have a good relationship with them. And I think it's a combination of how notable and smart are they, and how workable a relationship do I have with them? How culturally aligned am I with them? If you don't integrate that last vector in there in terms, you could be in for a world of hurt. I mean, especially very smart people, once you put them in a role like a board, and they have fiduciary duty to to the company, and if you don't see eye to eye with them, they're going to be working against you, and not because they want to, but because you didn't take the time to understand whether or not there's alignment there in terms of cultural values, in terms of how to grow the business, and these are not you know these are not conversations that are difficult to have. I mean, it, you can have them over 2 or 3 or 4 sessions. It doesn't take years. Sometimes those are the best ones to put on your board because you know them so well and they know you so well, and that when you know the proverbial punch in the face comes into the company and the board's sitting there and coming up with strategies of how to deal with this, you have someone there that you trust and they trust you, and you're all kind of working together, shoulder to shoulder. So I've always used that as a way, when I talk to them of evaluating, what would be a great board member. Obviously someone really smart, someone with great accomplishments, but you know, can I get along with them? How do they think about growth? I'll read about stuff that they've written or said or interviews or whatever, and preferably if I had an opportunity to work with them in advance, or have other conversations with them outside of a board context. So again, always integrating information and getting the view of just what's this going to be like in good times and bad times.
And
And I'm
yeah. No, yeah. I was going to say, I mean, especially with your capital allocation strategy, when you're looking at so many deals and doing a lot of M&A, that board of directors is
yeah,
so vital to everything that you do. I'm sure that comes into your mind all the time when you're thinking about a new deal. You're like, okay, what will the board say?
absolutely, and of course we do a lot of deals now, so um, there it doesn't there's just so many deals that it doesn't make sense for the board to opine on every single one to a
Of course.
very deep degree. But of course, you know, especially any kind of material event for the company, um, it's great to have a strong board because um, they'll find your blind spots, they'll bring them up, they'll ask you questions, and it makes you better. And so I'm really fortunate to have a board that does that for me, and so I've definitely grown, and the company's better for it as a result.
Very good. All right, Hamed, we're rounding the corner here. I only have a few more questions for you, but here's going to be your thought leader type questions. So I hope you're ready for these. Here we go. So, so what would you say has been the biggest learning lesson being CEO of a publicly traded microcap and now small cap company?
I Listen, to me, and you may have heard me say this before, it's the importance of leadership. It's at the end of the day, whether or not it's a public company, it's a private company, you know, you're in a role where people are following you. They are, and I think you're everything that you do, they're watching your every move, and you can't lose your cool. You have to be measured, you have to be strategic, you have to be humble. No one wants to work for some braggadocious fool, and you just have to be thoughtful about all the different ways in which your business is growing, and how, whether it's people, process, capital, strategy, and creating buy-in, making decisions in such a way that engender trust. Everything that happens in your company is an opportunity. It could be a terrible thing that happened. It's still an opportunity. It's an opportunity to create more trust with your team. It's an opportunity to create, relationships with analysts. There are management teams that freak out when bad things happen and they disappear. No one can get a hold of them. Well, that's the worst thing you can do. It may feel comfortable to do that because you don't have to answer a bunch of hard questions, but those are the moments where you can engender real, trust and create relationships when things aren't going well, right? So that comes from, I think, truly aligning yourselves with, the principles of leadership, and not trying to make populist decisions that are just going to help, boost your kind of profile for the moment, but making good decisions that are sustainable. I think for me, I'm a student of leadership. I think about how do I be a better leader every day, and that's why I study great leaders, and I think it's really, you've probably heard me say this before. I think it's a currency. Leadership is a currency that you use to solve problems, and that's because great leaders are resourceful, and that so you can acquire resources or you can be resourceful. And finding resourceful leaders is probably one of the best things you can do for a business. And yeah, so that's a big part of how I think about my journey and answer your question.
Very good. All right. So my final question for you today, then, what advice do you have for CEOs of private companies looking to go public as a microcap, or new CEOs of publicly traded microcap companies where this is their first gig?
I think when you just understanding that when you go public, you are signing up to a much more, public role as a leader. And so that's going to test you in different ways. It's still, it's still a lot of the same things. You got to run your company, you got to grow it, but now you have to do it with providing disclosures, understanding that there's a level of transparency that's required that's very different to what private companies have to endure. And that rigor and that discipline is at first hard. It's a lot. There's a lot that you have to think about, but I think it's very good for a management team to develop that rigor and discipline. It gets them into planning. It gets them to thinking about, what they're doing. And I always found talking to smart people, whether it's investors, brokers, high net worth people, analysts, whatever, different factions of the capital markets, that those conversations always helped refine my strategy, because they would, these are people from all walks of life, and they would ask you great questions. You would say, gosh, yeah, that's a really good question. And you would answer them, but then, each time there's like a bunch of seeds that get planted in your mind and they start to grow. And so, if you just have to realize that it takes a different mindset. You have to be willing to talk to a lot of people you can. If you're more of an introvert and you want to put your head down and develop technology and surprise everyone with a breakthrough product, I'm not sure, and you don't want to get out there and talk to a bunch of people. I'm not sure you can just say, gosh, I'll go public because I want to raise the money and I'll just hire people to do the capital markets. I'm not sure it fully works that way. Maybe it can at times, but capital markets wants to talk to business leadership, and they want to at times know exactly who is running that company and the quality of decisioning that's coming from that person. And the only way that they'll get there is by having those conversations. And so, it's just it's a different world. One that I quite like. Again, I think more often than not, yes, there are sharks in these waters, and they're not. Some of them are not well intentioned, but I think most people are very well intentioned. Most people want to help. Most people are rooting for you. And yes, you could sort of go into your shell and decide that everyone's out to hurt you, and you're going to protect the company, and be very sparing and limited in terms of your communication. But I just think you're hurting yourself ultimately, because there's most of the ecosystem is helpful and wants to see you succeed. So that's what I found.
I think that's a great way to end it right there. So, Hamed, where can my audience go and find more information about Well Health?
Yeah, thanks for asking. You can just go to our website at www.well.company, and that provides a good jump off point for different divisions and assets. And obviously Google's a great place too. You can just type in whatever you want: Well Health, telehealth, Well Health clinics. I mean, our telehealth business is called TIA Health here in Canada. It's called Circle Medical in the US. So we have different divisions, leaders, and assets, and all kinds of great businesses and people in our ecosystem.
Very good. Hamed, this was an absolute pleasure. Thank you so much for taking the time out of your busy day to do this with me today, to share your insights and your experience with everybody listening right now or watching. And good luck, stay safe, and I look forward to our next update.
Yeah, thank you. Thanks for having me, Robert. Really insightful questions. It was a lot of fun to chat. Look
Thank you.
forward to seeing you. Take care.
Take care.